Hey, what's up, you guys? I'm Marc Sinnott with Urbana Real Estate. And in this video, we're going to be talking about qualifying for a loan. What do you have to do if you're getting ready to buy a property and apply for a mortgage? But before we get into that, today's video is actually going to be a little bit different. I'm trying out a new format here. So because a lot of the questions that I get from buyers tend to be around the topic of loans, how do you qualify? How do you figure out how much house you can afford and what your payments are going to be? I figured instead of me just yammering at the camera like I usually do, let's go directly to the source and let's bring in an expert lender so we can ask these questions and we can have the conversation. So I actually have a special guest for today's video. His name is Christopher Lapp. You guys are going to meet him in just a second. But Chris is somebody who I've personally worked with. He's helped me with loans on my own real estate projects, and he's also helped a lot of clients of mine. So Chris and I have been in the trenches together working on real estate deals over the past several years now. And he's somebody who's incredibly experienced. He works with a lot of different loan products, and he's also really good at explaining how the process works to buyers of all different experience levels. So I'm really, really excited for you guys to meet him. And without further ado, let's bring in Chris.
Hi, good morning.
Hey, how you doing, man? Good to see you.
Good.
All right, so really quick, do you want to just introduce yourself, your company? How long have you been doing this?
Hi, I'm Christopher Lapp, and I'm the principal of the Black Oak Group. The company's been around for 31 years. We're based in Los Angeles, coming up on closing 8,577 escrows, which is shocking. I still have a good attitude, more or less. And definitely here to answer any type of questions as we get going, how the process works, what's the path of least resistance, and to actually end up enjoying your purchase experience. I think that's really important. So much drama is around it, but it doesn't have to be if you do some pre-planning.
Yeah, absolutely. Well, I appreciate you being here. And yeah, we definitely know that the process can get stressful and dramatic, but I definitely always say that it helps to have, people with experience who can, walk you through the process and help to keep the drama to a minimum. So, and I definitely think that's what we've done. And anytime that you and I have worked together on deals.
Yeah, I think a lot of people thrive on the drama. It doesn't have to be so dramatic as much as it has to just keep your eye on the ball, be focused, be laser focused, and have your ducks in a row beforehand. Surprises coming in are going to happen, but they could be certainly mitigated. So you can actually see I'm sitting in the middle of a construction zone.
Yeah, so I love that.
I just got a house, and so I do practice what I preach. And it was interesting because it brought a lot more empathy as a buyer.
Yeah, and you always like to work with professionals who use their own product and who have been through it themselves.
There's nothing like going through it. Running that deposit, to when you first start, it's a huge leap of faith and a commitment, and certainly something that shouldn't be taken lightly, but also should be like a part of your big financial strategy and goal where you're actually going to end up and where you want to end up.
Yeah, for sure. Okay, so for the purpose of this video, I wanted to just go through kind of what should a buyer be thinking about when they're getting ready to apply for a loan. What do they have to do to get themselves ready, to get themselves in the best kind of financial shape, understanding credit and down payment and cash reserves and all those things. And then sort of what do lenders look for just so that a buyer can be prepared when they do start talking to a lender. So why don't we start with what's the difference between different kind of lenders that people might encounter when they're out there? I mean, people say lender, but they might be talking about a banker at your local Wells Fargo or B of A or a mortgage broker or somebody else. So kind of what are the different types of lenders and who might be right for you in certain situations?
That's a great question to start. Can I backtrack just a bit?
Yeah.
I would think that a question I get more than anything is it a good time to buy? And I think we should look at the bigger picture. It's a good time to buy when you're ready to buy. I don't care if the market's up, down, sideways, or around, but you have to figure out what's best for your personal financial situation, not other people's financial situation.
Yeah.
So I think that's my point. The market's very hot right now, and I bought a house. So it doesn't matter, but it worked for my situation. So I think you have to really internalize that and think, well, what's going to work for me and what's the next step? So
Yeah.
many people, I think, are, what's the expression? Paralysis to analysis.
Oh yeah. Analysis paralysis. Yeah.
Whatever that is, I don't.
And I think everybody's been there at one point or another, but yeah, at a certain point, you got to kind of take the leap.
And yeah, and figure out what's best for you. So getting back to your question, I think that we were brought up to go to your local bank branch and, apply for a loan, and then they give you a mortgage, and then they give you the keys, and then you're done. Well, the market doesn't really work that way anymore, especially after the mortgage meltdown of 2008, 9, and 10, where banks honestly really are no longer in the mortgage lending business. They do it because it presents a good front, but they're in their interest for themselves, not for you, for sure. So, I say that because, once you get locked into one, you're not going to be able to bounce around, especially after all the angst that they put you through. So having said that, there's a lot of different options, and people think, oh, I go to my credit union. Credit unions are, I shouldn't say this, credit unions are probably worse than banks. They're really not in the business to lend out. Banks and credit unions basically make their money on credit cards, car loans, consumer credit, not to hold a mortgage for 30 years at 3%. That's not in their best interest. That's a big commitment for them, right? So, having said that, there's a lot of different options out there, and I'm certainly not plugging myself. One option would be to find a local mortgage broker. I think that would be the best strategy. How do you find a local mortgage broker that you trust? You can certainly ask your friends. I think that's word of mouth is always the best way to go. Obviously, a real estate agent is another good way to go. And if you don't know either one of those two, you could Google the National Association of Mortgage Brokers and Bankers, find someone in your neighborhood who is accredited. And then once you get 2 or 3 different options, call the person and ask them. Nobody's ever asked me what my experience background is. I think it's like going to a doctor or a CPA or a lawyer. I think I would ask them, how many deals they've done? Are they new in the business? What are their sources? Get some information.
And it's funny because people ask that question of real estate agents all day, every day. How long have you been in the business? Yeah. How many deals have you done in the neighborhood? That's usually the first question that people ask.
Oh, really? That's interesting.
Broker, but yeah, so I guess they don't think of that when they're going for their loan broker.
If they say Uncle Charlie just used this guy, just use them. But they might have a completely different goal set, if whatever their goal set is different from your goal set. So I think I would interview the person, and friendly does go a long ways because you're going to get to know the person well.
And so just to kind of clarify, a mortgage broker is somebody who can actually pull loan products from different lenders. Is that right? You're not just tied into working with one bank or one kind of originator. You can shop around the market for different products.
My company is the Black Oak Group. So we have contracts with about 55 different kinds of lenders, from A lenders, B, C, D, construction, all different types. And so when the application goes in, it has my logo on it, and I could send it to lender A, right? And if lender A rejects it, I could send it to lender B, C, D. If you go to B of A, Wells, Chase, any of those guys, you're stuck. Whatever they're going to get you, you're going to get you. Or after you go through the process and you get turned down, what are you going to do?
Yeah.
So they're only square one.
They're only pulling from their own,
from their own pool.
Yeah.
And of course they're going to be sexy, and they're going to say they have this and they have that. They're going to give you a break and blah, blah, blah. But at the end of the day, they're in it for their own skin. People say, well, how do I get paid? I think that's a great question. Yeah. There's two ways that I get paid. The lender pays me for sending them a clean file, right? That's kind of the number one. So there's no overhead. That's my portion of it. Or the buyer pays me directly through escrow.
Okay. And what are the situations where one or the other of those might happen?
It depends on credit, which I think we should talk about next. And it also depends on the short and long-term goal of the property. And, you know, if you're going to fix it and flip it, if you're going to live in it forever, or what's that? And then there's obviously a bunch of different scenarios, like we even talked about before. What's your break-even point?
Yeah. Okay. Since you mentioned that, then let's get into credit a little bit, because I think a lot of buyers, when they're thinking about applying for a loan, they want to know kind of like, okay, I have, let's just say, a 750 score or whatever, you know, what score do I need to have, and then what are the items that appear on my credit report, and how do all those, you know, factor into what kind of loan I'm going to get, what kind of interest rate I'm going to get, you know, what my payments are eventually going to be.
Yeah, but credit is probably the second biggest question I get, and I think it's probably one of the most important ones. You don't need great credit until you go to buy a house, right?
Yeah.
That's kind of the point, right? Let's start with, here's a question I get all the time. Don't pull my credit report because too many inquiries are going to dump my score.
Yep.
That is generally true if you're using consumer credit. The computer algorithm works okay if you use a mortgage broker or bank or whomever. Within a 30-day period, it won't ding your score.
Yeah. So if you're going to get one hard inquiry on your report, then you should go ahead and get whatever other, you know,
yeah, there's not going to be a great effect, but I have people freaking out. Oh, you're going to pull my score. Well, then go use a mortgage broker, and then he could shop that credit report around to 5 or 6, 10 different places and only have one hard pull on it.
Yeah.
So getting into that, your score has to be generally, and these are all general questions because it depends on what your short and long-term goals are, it has to be over 620. Right? There are some lenders that do over 580, but 620 kind of gets you into the game.
Okay.
Over 720 gets you into the A list. You know, over 740 is in the triple A list. If you're over 760, you get the best of the best of the best.
Okay. So that's one of those thresholds that, you know, lenders look at. If you're above this level or below this level, that's going to affect your interest rate, or kind of how much risk the lender is taking by lending to you.
Right. And, you know, a lot of people use Credit Karma to check their score, and that's kind of a very broad brushstroke, and it's not going to be exact. So when I pull a credit report, I get 3 per person. So let's just say if there's up 2 people involved, they take the 6 scores, they take the lower of the middle 2. So if you're buying a house with somebody, then you have to really check that out, because people freak out. Oh, my score is 800. But your partner's is 600. They're going to take the 600 score. And why? The lender is all driving the bus, looking in the rearview mirror, right? The credit score is the risk to them. Yeah. And that's the only way they know they're going to lend you $1 million or whatever it's going to be for 30 years. They have to be pretty sure that you're going to pay them back. I mean, that's kind of the number one thing. That's why credit becomes so important at a certain point, because that's all they have, right? Another important thing is they really like to see 4 trade lines, you know, 2 Visa, 2 MasterCards. American Express is less, you know, Banana Republic gas cards are the worst. They have
any like store credit card, a Macy's card.
Those are so bad. They'll ding you 30 days late if you're 1 day late, right? So Visa, MasterCard, Visa, MasterCard are the best. And they really want to see 4, you know.
Yeah. And then what about different types of credit on their, you know, car loan or lease or personal loan, line of credit, things like that?
Don't be late. Right. Yeah. Just do not be late.
So just make sure you don't have any derogatory marks on there.
That's probably, that's certainly my advice. And it happens that we're traveling and we forget to pay the bill, right? They do give you a 20-day grace period. Make sure you just really pay attention to that. You know, it's something that none of us want to do, but it really has an effect in the long run.
Yeah. Okay. So let's say a buyer's, you know, they know they're going to be buying a house in the next year or so. They're working on getting their credit into good shape.
Squared away.
Yeah. What do they need to know in terms of, you know, how much do you have for a down payment, and, you know, your cash reserves, and sort of what's the bigger picture of how much money you're going to be needing to show in order to put in this loan application?
Right. That's probably the third most important question that I get. You know, most people, you hear the rumor 20% down, 20% down. Well, that's not really true. There's so many different types of, we call them products. the minimum is about 3.5%. 3.5% down will get you into the party. I think that's kind of important, especially as a first-time home buyer.
And that would be something like an FHA loan or a special
yeah, it's an
product like that.
FHA vehicle, and people, you probably don't even know what that actually means, but it's just a the government is guaranteeing the 20% down that you didn't put into it. You pay a higher rate, you pay higher points and fees, which we'll get all into that. But if it works within your goal, maybe it's more important to get the house than to worry about all that minutia. I think it's really super important. Let's just say if you're a 5% down or 10% down, 20% down is the magic number, because lenders know if you put 20% down, you're generally not going to walk away from your 20% down.
Yeah, they want to know that the buyer has some skin in the game, right?
Yeah, definitely have skin in the game. And I think that makes them feel more comfortable, and then they give you a better deal because they have less risk. From their point of view, it's always only about risk.
Yeah.
So the government picks up the slack if you put down less than 20%. But I think more importantly, that besides the down payment, there's some extra closing costs that people never remember or factor into the equation, which always is a shock, right?
Yeah, and you never want that to be a surprise that pops up, right before closing.
We had that situation. It was a surprise at the end where, the buyer, they have to have homeowners insurance, so you have to pay that first year policy up front, right? There's property taxes that will come due, not to surprise you. There's interest on the loan that comes due. And then there's escrow, title, the lender, those costs that go involved with buying a house.
Yeah.
So,
and then lots of knick-knack fees, the messenger and the notary and the appraiser. Everybody's got to get paid.
It's all kind of BS, but there's no wiggle room around it, because that's the system that we have right now. But I like to add about 2% on for just closing costs on top of whatever the purchase price is, besides your down payment. So you have your down payment, another, let's just say 2.5%, just to be safe. And
I think that's a good rule of thumb.
A barometer. Also, something that a lot of lenders require are 3 months reserves. Now, this is always a big surprise. So you'll have your principal, interest, taxes, insurance, if it's a condo, HOA, right? That's your home payment nut.
Yeah.
Well, they want to make sure that they're not going to tap you out, right, at the end of the day. So they like to see typically 3 months, what they call reserves, left in your bank account. You didn't have to spend the money, but they want to make sure that it's sitting around. They will look at your 401k. They'll look at retirement funds, but they'll give you 70% of that value, because they know that there's a if you take it out. But you can use that as well.
So apart from if you have that cash in the bank, that's great. But let's say you have some of that money in your own personal brokerage and investing account, or in your IRA, your 401k, something like that. So they will actually consider, those funds, but they'll just give you kind of a discounted total on it.
They call it a haircut, right? Just to make sure that, because if you had to pull it out in an emergency, you're going to pay some penalties on that. But the lender says, well, at least they have backup funds in case there's an emergency that they could actually get away with and continue to pay their mortgage payment. That's all they care about, is the risk and the payment.
Are you going to keep paying? And they basically want to know if you have some sort of interruption of your income. If you lose your job or something happens, you can still make your payment for a few months while you kind of get everything figured out.
Yeah, for sure.
Okay, so that's going to do it for part 1 of the interview. We actually ended up covering so much information when we were talking to Chris that we decided to split it into 2 parts. So make sure to check back for part 2 of the interview, which is going to be posted next week. But in part 1, we covered a lot of the basics of what do you need to know when you're qualifying for a loan. In part 2, we're going to delve even deeper into some of these topics, like what else does a lender look for? What about people that are W-2 employees versus somebody who's self-employed or a business owner? What do they need to provide? What are some of the new requirements that have been put into place since COVID? And some of the metrics and the ratios that the lender looks at, like the LTV, the DTI, a lot of these acronyms that you're going to hear thrown out during the process, we break those down. And then lastly, what is the one biggest mistake that you should avoid as the buyer when you're going through this process? So a lot of really important stuff. Make sure you check back for part 2 of the interview. But once again, you guys, I really hope you enjoyed the video and that you learned something. Please hit the like button for me down below and subscribe to the channel. And of course, check out our website, urbana.realestate, and follow us on social so you can stay up to date on everything we're doing, all the content that we're putting out. But once again, you guys, thank you so much for checking it out, and I'll see you in the next video.